Hey there. So, you've probably heard people talking about index funds, right? They're often mentioned as this perfect first step for anyone new to investing. But what are they really? Well, in the next few minutes, we're going to break down exactly what they are, how they work, and why they've become so incredibly popular.
So, yeah, if you're kind of looking for a simple, no nonsense way to get started in the world of investing, you are in exactly the right place. Let's just dive right in.
Okay, so at its very core, an index fund is a type of mutual fund. But, unlike other funds with all these complicated strategies, an index fund has just one very simple job to follow, or you could say copy, a specific market index. That's pretty much it.
To make this real, let's take a look at a famous example from India, the Nifty 50. Now, the Nifty 50 is just an index, right? It represents the performance of the top 50 biggest and most traded companies on the stock exchange. Think of it as a quick snapshot of how the major players in the market are doing. And listen, when we say it copies the index, we mean that literally. A Nifty 50 index fund will invest your money in the exact same 50 companies as the index. And, this is the important part, in the exact same proportion. So if one company makes up, say, 10% of the index, it's going to make up 10% of the fund. It's like a perfect mirror. And this really gets to the whole philosophy behind an index fund. The goal here isn't to be some kind of hero and beat the market. Nope. The goal is simply to match the market's performance. You're basically signing up to get the average return of the market. Nothing more, but also nothing less.
So, we know what an index fund does, but how does it actually pull this off? Well, that brings us to a really important idea in the investing world called the passive investing approach. On one side of the coin, you've got active investing. This is probably what you picture when you think of investing. A fund manager doing tons of research, trying to pick the next big winning stock to outperform everybody else. But then on the other side, you've got passive investing. With an index fund, the manager's job isn't to make brilliant stock picks. Their job is just to make sure the fund perfectly follows the index. It's all about following a simple set of rules, not trying to predict the future.
And this super simple, hands-off, passive approach, well, it leads to one of the biggest, most powerful advantages for you as an investor.
And that huge advantage, it all comes down to one thing: cost. Let's talk about why this little number, called the expense ratio, can make a massive difference to your money over the long haul.
Now, of course, it's always important to remember that any investment in mutual funds does come with market risks.
And here's why those costs are so different. Active funds, they have to pay for big research teams, tons of analysis, and all that frequent buying and selling. That all leads to higher fees, or what's called an expense ratio. But index funds, they don't have any of those costs, so their expense ratios are way, way lower, as you can see by that much smaller bar on the chart. That tiny difference in cost might not seem like a big deal in just 1 year, but stretch that out over 10, 20, or even 30 years, and the savings just compound like crazy. A lower cost means more of your money actually stays in your account, working for you, which can lead to a much, much bigger pile of cash in the end. All right, so they're simple, they're low cost, that's great. But what about the returns? What kind of growth can you actually expect? Let's set some realistic expectations here. If you look back, historically, a big market index like the Nifty 50 has delivered average annual returns somewhere in the ballpark of 10 to 12% over long periods of time. And since an index fund's only job is to mirror that index, well, it aims to give you that exact same return, just minus its tiny fee. So what you're looking at is a really clear trade-off. On one hand, you give up the chance of outperformance. Your fund isn't going to magically double the market's return. But in exchange for that, you protect yourself from the very real risk of underperformance, which can totally happen when a fund manager just makes some bad bets. You get the market average, plain and simple. So, with all that said, is an index fund the right move for you? Let's figure out who this strategy is really for, using a really simple but powerful way to think about it. Instead of picking one star player, you're investing in the entire team. Index funds are honestly a fantastic choice for a few kinds of people. They're perfect for beginners because they're so easy to understand. They're great for long-term investors who have time to ride out the market's ups and downs. And they're amazing for anyone who just wants a simple, set it and forget it kind of investment without having to watch the markets all day. And that brings us right back to this key idea. Trying to pick the one stock that's going to be the next superstar, it's incredibly difficult, even for the pros. But with an index fund, you don't have to. You're just betting on the collective success of all the biggest and best companies out there. You're buying the whole team.
Okay, let's bring it all home. what's the one big idea you should walk away with? What is the real power of an index fund? If you remember just one thing from all this, let it be this. Index funds are not about trying to be smarter than everybody else. The entire idea is to simply grow your wealth with the market, step by step, patiently, and to do it all while keeping your costs as low as humanly possible.
So, I'll just leave you with this question to think about. In a world full of complex strategies, all promising to beat the market, could it be that the simplest strategy of all, just matching the market, is actually the smartest move you can make for your long-term goals? This conversation is for educational purposes only. Mutual fund investments are subject to market risks. Please consult a qualified professional before investing.